Good afternoon, everyone. Our panel's got the unenviable task of presenting the investment case for South African equities. But before I get into the body of my presentation, there's two important points I'd really like to highlight. The first one is I think it's incredibly important to distinguish between the macroeconomic environment and the prices you're paying for assets within that environment. So there's any number of studies that have demonstrated there's little to no correlation between long-term GDP growth and the underlying investment returns you can get in that country, and that's across geographies and across longer time periods. So if you asked me, what's my outlook for South Africa, I don't pretend to be able to predict what South Africa is going to look like 10, 15, or 20 years from now, but I do think you can infer, based on available evidence you can see around you and from history. And so we're far from bulls on this African economy. In fact, our base case would probably be that we expect more of the same, relatively muted growth, and the odd kind of own goal and frustration when you see things happening at a government level. But despite that, I think it's really important to highlight that there are a number of domestic companies that can actually are positioned to do quite well despite a relatively muted economic outlook. And then the other companies that are pricing in such a dire economic forecast that actually if things just turn out okay, they can do relatively well. That's the first point. And then the second thing I'd really like to highlight is there are any number of businesses that happen to be listed on the JSE, but for all intents and purposes, their fortunes are not tied to the South African economy at all, either because they're multinational companies with little to no earnings here, or they have operations here, but they earn almost all of their earnings offshore in hard currencies. And so I think to demonstrate this, and the interesting thing is we're actually finding opportunities in both those buckets, and we're very much bottom-up value investors. So the easiest way for me to demonstrate this is to give you three examples. So the first example of where we're finding opportunity is something like GLENCORE. So GLENCORE, global multinational, little to no operations really left in South Africa. They've just got a small coal business really that's still here. And so your question might be, well, what doesn't the market like about GLENCORE? What's presenting the opportunity? Well, GLENCORE produces and sells over 100 million tons of coal per annum. And if you think about what the IEA has forecast for us to achieve our sustainable transition to a 1.5 degree scenario, the world is going to have to dramatically reduce their consumption of fossil fuels and coal in particular. And so what this chart shows you is the forecast expectation for the global demand for oil, coal, and gas. And you can see the outlook for coal demand is really dire. And so people are obviously quite concerned about Glencore's future. Now, we don't pretend to be coal bulls, and neither are Glencore. They've actually committed to responsibly reducing their coal production over time. But what I think the market is failing to appreciate is also for us to achieve our ambition in terms of completely rejigging our grids across countries and across geographies, is we're going to have to invest a huge amount in renewable technologies, greater electrification of the grid, much more wind, much more solar, much more electric vehicles. And actually, the commodity intensity of some of those technologies is much greater for particular commodities, specifically copper, nickel, cobalt, and zinc. And those happen to be 4 commodities which are very big in the life of Glencore. So this chart now shows you if we achieve that 1.5 degree scenario, over the next 30 years, we're going to have to more than double our consumption of copper and zinc and more than treble our consumption of nickel and cobalt. And so if you put it together and you look at Glencore's history and future, what this chart now shows you is the free cash flow generation of Glencore. This is after capital expenditure, but before interest and tax. And it gives you a little bit of a history of the split of where those profits are coming from. And then if you look on the far right, the last 2 columns, the second last column is what are they earning at spot commodity prices, and what are they earning at what we think are more normal commodity prices over the long term. And the one ironic thing to maybe highlight is, in the short term, coal has actually benefited from this huge reduction in supply, but demand hasn't fell at the same level that we've seen supply. Almost nobody is spending money on investing in brownfields or greenfields coal mines, and so there's been a huge drop in supply. And as a result, the coal prices actually rallied. We don't think that's normal. So we actually think a normal coal price is much lower. So if you look at the grey bar, that comes down materially. And actually, for some of the other commodities, even though we think there's quite a rosy outlook, something like copper, you can see we actually forecast copper falling off quite materially as well. And so what are you paying for this? Well, Glencore at spot, after capital, after interest, after tax, generates about $12 billion of free cash flow. The market cap is around 60 billion, so you're paying around 5 times spot free cash flow of Glencore. We think normal prices, normal free cash flow is roughly half that, so around 6 billion, in which case you're paying about 10 times for Glencore. And then just out of interest, to show kind of the disparities we're seeing in some global market, I thought I'd compare with one of the highest quality consumer brand companies in Coca-Cola. And on the right-hand side, Tesla. So if you look at Coca-Cola, for example, in the last 12 months, they've generated about $10 billion of free cash flow, and it's quite a mature business. I'd say that's probably normal, but you're paying around 23 or 24 times that free cash flow for Coca-Cola relative to Glencore. And then on the right-hand side, I put one of the darlings of the market at the moment, Tesla, market cap of 700 billion. At the moment, they're not really generating any free cash flow, and I don't think anyone knows what normal is for Tesla. But as a proxy, we took the best ever year from Toyota. Toyota produces over 10 million cars a year, and we doubled it. And we said in that instance, Tesla will generate about $20 billion of free cash flow versus a market cap today of around 700 billion. So there's huge disparities. That's the one example. And then if we look more domestically where we're finding value, one of the places where we're seeing a lot of value is in some of the traditional banks in South Africa. So, the 4 traditional large banks, Nedbank, Absa, FirstRand, Standard Bank, all of their share prices today are lower than they were at the end of 2019. And the one where we're seeing the most value is Standard Bank. And so what you have here is the long-term history of Standard Bank. I don't think 2020 was anything like a normal year. It's massively elevated bad debts and provisioning for further expected losses, reduced lending, reduced transactions. So if we just look at the 20 years from 99 to 2019, over that period, Standard Bank was able to grow earnings by around 11% per annum. And the payout ratio increased over that time as well. So actually they were able to grow dividends at a fast rate of around 14.4% per annum. Now you might say, Rory, that's all very well, that's great. But what does it look like from a global investor perspective in dollars? Because there's been a lot of rand weakness. Well, if you compare Standard Bank to JP Morgan, which is widely regarded as one of the best banks in the USA, and you index them both to the same earnings level in US dollars in 1999 of $1 per share each, at that point in time, the payout ratio for both companies was around 30%. So you were getting around roughly 30 cents in dividends for every dollar of earnings. Today, in dollars, up to 2019, Standard Bank is earning around $3.40 versus around $2.90 for JP Morgan. And over that entire period, Standard Bank actually grew dividends faster. So the dividend is more than double what you're getting from JP Morgan in dollars. And then on a cumulative basis, the returns of dividends have been 3.1 times greater for Standard Bank than JP Morgan. And then again, if you say, well, what am I paying for Standard Bank today? So the share price today is around 145 Rand per share, and we don't know what the future holds. So what I've done here is I've shown you a variety of potential scenarios. The first column is, well, let's assume 2020 was normal. We don't think it was, but if you think it's normal, they earned around 10 Rand per share. Historically, Standard Bank's traded on between 8 and 15 times earnings with an average of around 12, but maybe you think the future is likely to be worse than history, so you say, okay, I think 10 times is fair. Then there's a little bit of downside that maybe normal on 10 times 10 Rand is 100 Rand a share. But then alongside that, we think that you start getting into the more reasonable probable outcomes. So the first one is already they've reported in the first half of this year, and there's been a material recovery. If you annualize that, that gets you around 15 Rand per share. So then you'd say, okay, well, Standard Bank looks really fairly valued to me. Again, we don't think this year is going to be normal. We think there's still quite a strong recovery coming. And if you said, well, actually, let's take the average of the last 5 years, including 2020, then you're getting to around 16, 17 Rand per share in earnings, in which case there's around 20% upside to Standard Bank's earnings. And then on the last two columns, you'll see management thinks they can get, within the next 2 to 3 years, the ROE in Standard Bank to between 17% and 20%. And so if you think the true outcome is somewhere between those ranges, then the true fair value for Standard Bank is probably between 200 Rand a share and around 240 Rand a share. And that just kind of gives you an idea of the skew we're seeing and kind of the potential outcomes skewed towards the upside with around probably somewhere between a 20 to 50% upside. And then the last example I'd like to give you is we're finding a lot of value as well for the first time in a long time in some of the smaller and mid-cap names. And one of the interesting ways you can see that, is you're seeing a lot of companies actually being taken private in the last 6 to 12 months. So quite a few of the smaller mid-caps have been bought out by management. Obviously, insiders think there's a lot of value to be had. And so one example is Blue Label. Now, I must caution you, there's probably greater risk in some of these small and mid-caps, so you probably want to own a basket of them as opposed to taking a big bet on one of them. But one example we're seeing value is Blue Label Telecoms. This chart shows you the history of their share price, and you can see things for most of their history went relatively well, up until 2016 when the share price peaked at just over 20 Rand per share, and then it fell dramatically. And of course, what did Blue Label do wrong? Well, they bought 45% of Cell C. And so what this chart now shows you is the long-term history on the balance sheet of Blue Label. So the red bar is the equity, the gray is debt or cash on the balance sheet. When it's negative, that reflects cash. And you can see for most of their history, they actually traded relatively conservatively. They were paying out a healthy dividend. They had net cash on the balance sheet. And then in the middle of 2017, they decided to inject 5.5 billion Rand into Cell C. All in, they actually spent just over 7 billion in also buying debt and buying one or two related businesses to Cell C. How did they fund that? They issued a number of shares. So you'll see the little orange dots, which reflect the shares in issue. That jumped a lot, and they raised over 2 billion in debt. That's the 2018 column where you see the large jump in equity and debt. And then the market was very quick to punish them because even a recapitalized Cell C still had way too much debt on its balance sheet. And so within a year, that impaired their entire investment in Cell C to zero and written down quite a few of the loans as well. And so where do you find them today? Well, they've cut the dividend, and they've actually now managed to trade their way out of it. They've written Cell C down to zero, and they've again got net cash on their balance sheet. And what does Blue Label's core business actually do? So the core business of Blue is airtime distribution, specifically prepaid airtime distribution, predominantly in the informal sectors and acting as kind of the gateway between people paying cash and converting it to digital. And interestingly enough, over time, a number of the banks have started using Blue Label as well to procure the airtime that they sell to their clients rather than go direct through Vodacom or MTN, and that's because they just get so much greater service and pricing from Blue Label as a wholesaler. But what this chart shows you is how much Blue's airtime has grown and how big they are relative to the airtime that MTN and Vodacom sell. So today, Blues sell in any 1 year around 35 billion Rand of airtime. The two bars alongside that show you MTN and Vodacom's total revenue, and then just below that I've broken out how much they sell in prepaid airtime. So Blue's airtime on a prepaid basis is actually greater than either Vodacom or MTN. And then our estimate of the total service revenue, including contract and postpaid subscribers, we think Blue sells around 30% of all the airtime sold in South Africa. So a very big business. And how does the valuation look? Well, this chart now shows you the share price on an annualized basis as shown by the red line. And then the gray bars are our estimate. If you strip out all of the funnies, all of the impairments, and you just look at what that core business has done over time, stripping out some of the other businesses they've sold over time. So they had a small business in India, they had a loss-making business in Mexico that they've also sold in the last year. But just what has the core prepaid business done, and one or two of the other businesses, they also do electricity distribution. Well, you can see that grew very comfortably over time. And the big drop in 2018 is them taking on additional debt and increasing the shares in issue. So on a per share basis, the core earnings dropped materially. But if you look at it today, you can buy Blue on less than 10 times those core earnings from the existing prepaid distribution business. And those are what we think are very high quality earnings because they can convert them pretty much entirely to cash. You're buying them at a more than 10% free cash flow yield. So what is the market still worried about is, well, they've announced that they're going to likely participate in the second recapitalization of Cell C. We don't think they're going to inject anywhere near as much money as they did previously. And more importantly, we also are quite encouraged by Cell C's changed plan not to try to compete with Vodacom and MTN on investing in their network. They're going to leverage off MTN's network. But nonetheless, we model them actually losing a further 1 billion Rand in recapitalizing Cell C, and we still think it's very attractive today. So in summary, there's 3 examples of kind of where we're finding bottom-up value in the South African market.